please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Our earnings season inaugural show, the Infosys show. As always, Infosys inaugurates the earnings season. This IT bellwether is due to announce its numbers anytime now, maybe in the next 2 minutes, 3 minutes, 5 minutes. And with me is our resident expert, Rima Tirulkar. Rima, we've been waiting with bated breath. Why don't you do one thing? Before the numbers come, just before the numbers come, update the viewers on the key P&L numbers that we have to watch out for.
Well, first, in Q4 numbers, dollar revenue growth around 2%. In margins, it should be 24.3%, largely unchanged on a sequential basis. In terms of the profitability, it will be lower optically on a quarter-on-quarter basis, and that is because the prior quarter got a benefit on account of a reversal of tax provisions. Strip that out, the profit that we're expecting will be down 0.5% on a quarter-on-quarter basis, and that number is around 3,679. In constant currency terms, growth will be seen around the 1% mark. So key number, dollar revenue 2%, constant currency growth at 1%, margins at 24.3%. This is what the number street is expecting by way of Q4 numbers.
Okay, so revenue should look like 2,800 something, 2,809 to be very precise, which would compare to $2,755 million, $2.75 billion. Okay, those are the numbers you would look for. Profit is not that very important now because of the adjustments in previous year's profits. But I guess guidance is all important when it comes to IT companies, especially Infosys.
Yes, so Infosys and HCL Tech are the only two companies in the large cap space which guide annually. And considering the run-up that we've seen in IT companies, the guidance will be important because that will, give it, it will prove whether the run-up is justified. We're working with a 6 to 8% constant currency revenue growth in FY19, which would compare with an actual expected growth of 6% in FY18. So 6 to 8%. It is likely that the management could be a bit conservative and guide for 5.5 to 7.5%. Lata, I was just checking that, in the last 6 years, only in 1 year has the company managed to deliver within the guided range. In most of the other years, there was a downward revision. Even last year, FY17 again, they had guided for 11.5 to 13.5%, and they finally ended with 8.3%. So the company, even, our memory, serves us that, there have been a lot of downward revisions. This will be the first quarter for Salil Parekh. There is Nandan Nilekani on board, who is, of that age where Infosys used to promise and over-deliver. So there is a likelihood that the company will, be a little conservative when they come out with their full-year guidance. So 5.5 to 7.5% is also not ruled out. But then if you're giving that guidance, which at 5.5% will indicate that there could be degrowth at the lower end, the company's commentary at least needs to be positive. If it is 6 to 8%, most of the market men we spoke to indicated that it's probably already priced in because the stock has rallied 12.5% since the start of the year. This week itself, it's seen a 4% rally. So a 6 to 8% guidance is in the price. A 7 to 9% guidance will be seen optimistic, and that will positively surprise the stock even from these levels.
Okay, you're thorough in the way in which the stocks have moved this year, this month, and this week, I must say, Rima. Okay, so that covers the numbers that we will look out for in terms of dollar revenue, margins, constant currency. You covered guidance. Now the internals. I suppose the first thing to watch out for is whether the banking and finance, the BFS, is clicking this time.
Yes, because the management has sounded confident on BFS, that's Banking and Financial Services. In the December quarter, it didn't do well. There was a degrowth, but that the management had said it was an account of seasonality. A couple of the large deals which they expected to ramp up didn't ramp up. There was a transformation taking place, but that is behind them. In their Q3 conference call on BFS, they had indicated that growth will pick up in this calendar year. Spending is fairly stable. There is a shift in spending from the regulatory aspect to the discretionary spending in BFS. So the management has sounded confident. They're talking about a pickup in growth, and we need that to reflect in their commentary, even for the coming quarters, because that is about 30% of their overall revenues. So BFS is going to be the key to watch. That apart, we will also look at the capital allocation policy. The company is sitting on 29,000 crore rupees. It generates significant cash every year. Their policy so far is their dividend payout will be up to 70% of their free cash flow. Plus, last year, they did a $2 billion or a 13,000 crore buyback. this year, what will they do? Will they continue with the dividend policy of up to 70%? Will there be another buyback? Or will the new management talk about perhaps they'll go a bit aggressive on mergers and acquisitions, and therefore they're reserving the cash for that. So capital allocation will be very important. And considering that this is a management transition year, we will also look very closely for client metrics. The top 5, the top 10 accounts. Has the company lost any market mind share with these clients? So that is something I'll look closely. And of course, it is they've started classifying the new age services. So they call it new software, new services, digital. These are numbers that they gave us last time. So just for a quick recap, the new services growth was about 9% of the overall revenues. New software was 1.7%. So on the whole, it was about 11.6% growth that they had. Digital was 25% of the overall revenues. So we will compare it this quarter, what the number is and the kind of growth they'll enjoy.
Okay. Yes, of course, digital or whatever you want to call it, SMAC, those would be areas that we have to look at. Vishal Sikka had the word renew as the area of focus, artificial intelligence. We have to wait and see if Infosys is able to, build on it, especially at a transition time. Whether they still had their eye on the ball in terms of the industry transformation that's happening. Okay, but now for the softer aspect, first full quarter of Salil Parekh, perhaps the first full press conference as well. I mean, he has been in the press, but not been grilled really by reporters and analysts. So one would want to see that as well. Do you see Nandan at all in the press conference or any reference to his continuation as chairman, anything like that? And how market moving would that be?
Well, Nandan is integral to Infosys. He's the one who's going to keep all the stakeholders happy, including the founding members who had raised concerns with Vishal Sikka. So Nandan Nilekani is going to be very key. What he had said last time, I will be there as long as I am needed. But one of the tasks was also board reconstitution and change, and we've not seen too much, on that. He's currently the non-executive chair of the Infosys board. So I guess what the street will want is that Nandan is still around to steer the company through this transition time. But he probably would not want to overstay as well. So I guess he will say that once my job is done, I will hang my boots so that there is no case of a dual power center. But I don't think it's going to be immediate. If it is immediate, okay, I think numbers are just out. So let's wait for them to...
We were waiting to get to Kritika to check whether she had the numbers. But at the moment, looks like obviously the stock exchanges will get to put out the numbers first. Remember what we're looking at
number. The net profit is coming at 3690. This is in line with market expectation. Our poll was at 3,680. So the consolidated net profit has come bang in line with expectation. 18,083 is what the company's delivered by way of revenues in terms of rupee revenue, and that also would be in line with expectation.
4472 would be in line.
No, 4472 is actually a beat.
A bit only.
It would be a beat. So
yeah, because you had 4416 as the polled number. 4472 looks
would
like
mean margins of 24.7%. So this is a beat compared to market expectations. Margins have improved by
revenue is 18,800.
Revenues are in line with, okay, we've got the dollar revenue
at 2805, which is absolutely bang in line.
So we've got
they've made it to 2%?
1.8%. So dollar revenue growth at 1.8%, slightly shy of street expectations, but I think it will be taken. Margins at 24.7% is a beat. So these are the two headlines. Dollar revenue growth very slightly lower than street expectations. 1.8% is what they've delivered. Margins have come better than street expectations, and FY19 constant currency guidance at 6 to 8%. Infosys has managed to deliver in the quarter gone by. So 6 to 8% is what the street was talking about. At 6%, it would be similar to what they have delivered in FY18. I'm just trying to tell you what the FY18 growth number is going to be for okay, we'll just wait.
Okay,
this is a little disappointing, by the way. Just before we go across to Kritika, margins have come. The guidance on margins is 22 to 24%, which means lower than what the company has delivered in FY18. So the constant currency guidance for FY19 bang in line with expectations, 6 to 9. Okay, they've revised it.
This is the
dollar revenue growth is at 7 to 9%, constant currency at 6 to 8%, in line with expectation. But the margin guidance at 22 to 24% is disappointing. They have lowered it from 23 to 25% guidance. Our colleague Kritika is there. She's at the Infosys headquarters. Kritika, it's over to you.
Looks like Kritika went away to meet Mr. Parekh. Okay, I think, yeah,
Okay.
actually we could see her walking with Salil Parekh, so looks like she will be speaking with the management. This looks like it's a beat on all parameters, except that niggling worry over coming margins. But if they are able to maintain the constant currency growth between 6 and 8%, then perhaps the street will look kindly at that smidge of a disappointment in terms of margin guidance. Remember, margin is 24.7 for the quarter just ended on March 31st. But for the year ahead, the company is guiding that 24 will be some kind of a roof. In which case, you have to work with perhaps something shy of 24, and that would mean a margin fall of 1 percentage point from current levels. So that perhaps would be something that the street will want to turn around in its head. Maybe we will have more evidence of optimism or otherwise from the press conference itself. But otherwise, it looks like on every box that you want to tick, it is in line with expectations. The constant currency guidance, constant currency growth guidance in particular at 6 to 8% is perhaps at the upper end of the street expectation, because there were some in the street who believed that 5.5 to 8 could be what the street would, the management would want to guide, just to protect itself from any possible downsides. But a confident 6 to 8 would mean that in the very least it's going to be as good as the current year, where they have delivered almost 6% in terms of constant currency growth. While Rima does the numbers in more detail, especially in terms of verticals, we have Sanjeev Hota, the research expert on IT.
So, Lata, just some more numbers. For FY18, the company has delivered 5.8% in constant currency terms. 5.8 is the constant currency growth in FY18, which means with the FY19 guidance of 6 to 8%, it is clear that growth will pick up in FY19. So that is the key thing. So growth is definitely better in FY19 at 6 to 8%, even at the lower end, versus the 5.8 that they've delivered. With respect to margins, there is clearly pressure, because FY18 margins were at 24.3% and their guidance is at 22 to 24%. So there is going to be pressure on the company's margins. It's not unexpected, because the company was anyway operating at peak utilization. So I guess they're being a little, I'm not sure if they're being conservative, but you can expect some amount of margin pressure because the headroom was on the lower side. I'll just come
to you in a minute, because the management might start, so we want Apurva Prasad to tell us his first thoughts. So before that, Apurva, what's the first comment? In line is good enough for the price to sustain on Monday?
Yeah, sure. So I think there was some concern, a lot of concern, skepticism in terms of the guidance, because being relatively on the conservative side. So I think 6 to 8% sets a pretty decent tone, for an acceleration for a company like Infosys. So I'm pretty happy about that.
Apurva, what about the margin guidance at 22 to 24%? There will be pressure in the coming year. How would you read that?
So I think while that could be cited as a slight disappointment, considering 23-25 was their band, but I think this is more to do with increasing the onshore presence, they've talked about, whether it's the 10,000 hiring in US.
Yeah.
So I think we were as it is at the midpoint of their earlier band at about 24%.
Okay, Apurva, just coming to you.
Slightly lower sort of a thing, but it won't change much.
Okay, Sanjeev, we're just setting the line right over there, and Sanjeev Bhasin has also joined us. Sanjeev, 5.8% is the constant currency growth this year. Now we know that for sure. Guidance is 6% to 8%. Your thoughts on the guidance itself?
Well, I think it's very, very reasonable, and it justifies the movement in the stock. There was too much pessimism, Lata. This has been an outlier, up 30% from those recent lows of 900. and I see no let up. I think this stock can gain another 10% over a period. So it will be a market performer, and I think the numbers are well in line of whatever the best estimates was.
Okay, I might read out the qualitative comment coming from Salil Parekh, the CEO. I'm pleased with our healthy revenue growth, profitability and cash generation in Q4. Our robust performance is the reflection of the strong impact we have had with our clients and the dedication of our employees. But this is the most important thing. Navigating your next. That's our aspiration of how we will partner with each one of our clients. Salil Parekh said we will execute our strategy around the 4 pillars of scaling our agile digital business, which is today 2.79 billion revenues. That's one. Energizing our clients' core technology landscape where artificial intelligence and automation. Third, reskilling our employees. And fourth, expanding our localization in markets such as US, Europe and Australia.
Okay, some more important details. You know, they've on their capital allocation, they have said that they will be paying out an additional 13,000 crore, that's $2 billion, in FY19. So their policy stays that they will be returning up to 70% of the free cash flow. But over and above that, the company will also be paying up to 13,000 crore rupees. One will be a special dividend of 10 rupees per share, which will be in June. And then the rest of it, which is about 10,400 crore, will be also paid out through the course of the financial year. So similar to last year, there will be dividend payouts of up to 70% of free cash flow, plus they will be paying out an additional 13,000 crore rupees, or that is close to about $2 billion. Also,
so with the free cash now, leftover receipts?
Yeah, well, I'll have to calculate.
Well, we'll come to that in a minute. Rima, maybe we can get Moshe Khatri in for the first few comments before the management starts speaking. The Managing Director of Wedbush Securities joins us on the phone line all the way from the United States. Moshe, I guess you got the first few numbers. It's 5.8% constant currency growth for the year that just ended and 1.8% dollar revenue growth for the quarter that just ended. Guidance of 6 to 8%, but margins 24.7% for the quarter gone by, but 23 to 24% guided for the year ahead, or rather for the current year. First thoughts?
Not surprisingly, inline numbers. If you look at some of the metrics, you know, North America was kind of flattish sequentially. Europe was a bit down. The rest of the world was pretty big, up 6%. We're looking obviously at BFSI, which was kind of flattish year over year. So we're yet to see any sort of uptick in top-line growth there. So I guess we're going to have to wait to hear in terms of what management has to say about that. Not a huge surprise about the margin guidance, given the fact that we are assuming that this company continues to invest pretty aggressively in reskilling, in digital, etc.
Praveen and Ranga.
Okay, well, Moshe, we have to get over to Salil Parekh, who has started speaking.
To report our Q4 results and our full year results, to share with you our strategic direction, and to share with you our guidance for fiscal 19. After that, I'll request Praveen and Ranga to share updates from operations and finance. In Q4, we had strong revenue growth, 9.2% in reported terms year on year for the quarter, and 1.8% quarter on quarter, again in reported terms. Our operating margin in Q4 was 24.7%. For fiscal 18, we had a growth of 7.2%, and our operating margin was 24.3%. Our financial services business grew 7.2% year on year. Our energy and utilities business 16.1%, and our Europe geography at 22.5%. These robust results demonstrate the underlying strength of our business, the commitment and trust of our clients, and the dedication of our employees. Now for some highlights from our strategic review and the updates that have come from all of the internal discussions. The strategic review was informed by discussions with clients, with our employees, with the leadership, and then through a review of the portfolio of all of our businesses. In fact, to share with you how our clients are looking at the world, the tech spend and the tech business, let me give you one example. Some weeks ago, I was with the CFO of a large US Fortune 50 company, a long-standing client of ours for over 15 years. And his comment back to me was, He's delighted with the work we're doing for them. He has tremendous trust in our delivery and a tremendous respect for all of the work and understanding that we have of his technology landscape. And he was even delighted in the work that we're doing to help him go on his digital journey as we were navigating him through all of the changes he was making, whether it was on data or analytics, on cloud, or on agile. Those were the sorts of discussions I've had with over 40 clients in the past few weeks, and that has really informed our strategy. Our strategy comprises of 4 pillars. The first, scaling our agile digital business. Today, our agile digital business is about $2.8 billion for fiscal 18. It's a business that's growing robustly in the quarter and for the full year. And it's a business that we want to invest in and now scale for the markets, clients, and opportunities ahead. The second pillar is energize our core. Our core businesses are extremely strong, and these are businesses that can benefit massively from AI, our NIA platform that will be applied all across, and from automation. The third pillar reflects all of the aspirations and the goals we've set for our employees. I want all of our employees to look at a reskilling agenda, both for what they want to do in the future, but also for what our clients are looking for from us and from our employees. And the fourth pillar really reflects the changing needs in the world today, is localization for us within the markets that we operate in. For example, the US, Europe, and Australia. The localization reflects scaling up of local talent in those markets and building some delivery centers as we've already done, for example, in the US that we've built in Indiana or in Connecticut. So those are the 4 pillars of our strategy. Agile digital scaling, energizing our core, reskilling our employees, and localization in the markets that we operate in. All of that around the framework, around the guidance of navigate your next, working with our clients to navigate their next. With that, let me come now to our guidance. Our guidance for fiscal 19 in constant currency terms, revenue growth of 6 to 8%, and operating margin between 22 and 24%. With that, let me pause and hand it over to Praveen, followed by Praveen will be Ranga, and then we'll take questions from you. Go ahead, Praveen.
Thank you, Salil. We had a good quarter on the operational front as well. Revenues from digital services increased to 26.8% in quarter 4, and for fiscal 18, it stood at 25.5%. During the quarter, we also saw 10 large deal wins, total TCV of $905 million. This is the highest quarterly TCV win in this particular year. Total TCV win for the year crossed $3 billion. The pipeline remains healthy. Utilization, excluding trainees, remains stable at 84.7%. Revenue per employee crossed $54,600 as compared to $53,700 US in quarter 3. This is a clear reflection of increased adoption of automation in our core services and improved operational efficiencies. In fact, while revenues for the year grew by 7.2%, the employee headcount increased by only 1.9%. Volumes increased 1.1%, and price realization was steady, was flattish. Once again, a reflection of increased mix of newer services and digital services in our portfolio. Attrition increased to 16.6% as compared to 15.8% the previous quarter. However, the high performer attrition has come down dramatically and at 9.4%. We are also pleased to announce compensation revision for 85% of our employees starting April. For rest of the employees, primarily middle management and senior management, it will be effective July 1st. These for both on-site and offshore. Similar to last year, there will be much more focus on differentiation based on performance and contribution. Majority of the employees in India will get we'll get rises ranging from mid-single digit to high single digit. With this, I will pass on to Ranga.
Thanks, Salil and Praveen. As Salil and Praveen mentioned, fiscal 18, we saw overall very good performance and most importantly, resilient performance. I'm going to talk about the margins, the cash flow generation, the capital allocation policy, and the dividends. In fiscal 18, our operating margins were very resilient at 24.3%. It was on the back of several operational efficiency measures that we undertook, plus productivity improvements. Talking about productivity, our revenue per employee crossed $54,500 in fiscal 18. It was a year-on-year increase of 6.3%. This is primarily on the back of the revenues growing at 7.2%, whereas the headcount grew just 1.9%. Our free cash flow during the year was very strong. It grew 15.3% year-on-year, double the rate of the revenue growth of 7.2%. And today, the board approved a revised capital allocation policy. The capital allocation policy has two parts. The first part, as announced in fiscal 2017, the board decided to continue to pay up to 70% of free cash flow to the shareholders for the corresponding financial year. In addition, for fiscal 19, the board has identified up to $2 billion to be returned to shareholders in a manner to be decided by the board subsequently. Out of this up to $2 billion, $400 million would be paid by way of a special dividend, which we have announced today. The balance up to $1.6 billion would be paid in a manner to be decided by the board subsequently. We'll make announcements in this regard as we make progress. Dividend, the final dividend that was announced today of 20.5, and if you include the interim dividend of 13 rupees, the total dividend is 33.5. The total dividend payout this year, excluding the special dividend, is 30% higher than last year. With this, let me stop here and we will await for questions.
Good evening, gentlemen. I'm Sajid here from Bloomberg Quint. Mr. Parekh, a couple of questions to you and then to others. The first one is with respect to the guidance of 6 to 8%. What are the factors you've taken into account while going for that guidance? You spoke about the strategic review which you've done. How is this different from the strategic path which was laid by your predecessor? And there has been a sale, you're planning to sell Skava and Pranaya. What is the reason for that? Do you think in hindsight that that was a wrong acquisition that you did? That's one. For Mr. Rao, you spoke about digital. What is the kind of the $905 million TCV, what is the new orders which came from digital, and what kind of margins are we seeing in that? Are you seeing still small deals coming in or bigger ones coming in? So Ranga, the margins 22 to 24% guidance, you are bringing it down by a bit. What is the reason for that? Are you seeing any headwinds coming in the quarter?
So let me start. Thank you. I think the three components or three questions. First, on the guidance and revenue, my sense of the market is we see a market that is in a stable to good condition. Our own businesses are doing well, as I described some of them. You heard from Praveen on the specifics of some of the other businesses within our mix. Given those external factors and our own positioning, that was a range of guidance that we developed. In terms of the strategic review, the approach I've taken, as I shared, was really meeting with our clients, our employees, our leadership, and then reviewing our portfolio. What you heard from me about our clients is really what's informed where we are going. Our strategy is built on where our clients' digital journey is taking them, and for us to have relevance for the future with our clients. And that's really why we have the 4 pillars. The first being agile digital, the second being energizing our core, the third being reskilling our employees, and the fourth pillar being building localization in the markets we operate in. In terms of Panaya and Scava, we did a strategic review of our portfolio. We looked at where our strategy direction was, which is what I just described. It comprises of digital and core IT services and a strong suite of product portfolio, for example, Finacle, platforms such as Edge, NIA, which we are further expanding, and McCamish, which is an insurance platform. And within that strategic review, we decided to initiate active interest in Panaya and Scava from external buyers because it did not fit all of the criteria we have today for scaling our businesses, given the conditions we have for the business today.
On the large deal front, 32% of 905 million TCV was net new. We don't track how much of percentage of digital from a large deal perspective. But there is an element of digital in most of the large deals, particularly with respect to cloud transformation, modernization, and so on. And in terms of overall the size of digital deals, the sizes are definitely increasing. But the deals are also becoming more complex because now digital is moving beyond the user experience, the front end, to modernizing the back end, the analytics, the integration between the front end and back end, and so on.
And the operating margins, as you know, for this year, that is fiscal 18, we had given the guidance of 23 to 25. Finally, we delivered 24.3, higher than the midpoint. For this year, the primary reason, there are 4 reasons. One, clearly we want to invest in digital wherever we are underinvested. 2, we want to foolproof our US talent model. 3, we also want to revitalize our sales for further accelerating the deal wins. 4, we also want to repurpose our employees given our digital journey. So these are the 3 things. So that's why we have said 22 to 24. But nevertheless, all the operational efficiency, productivity focus that we have shown in the last 2 years, there will be unwavering focus on that. But at the same time, we want to invest to leverage the business opportunities.
Just to add, the write-down on Panaya and on Scava, if you can elaborate on that.
Sure. See, Infosys has over 40 subsidiaries, right? Of which Infosys Limited is the largest group. So Infosys Limited invested in Panaya and Scava by way of acquisition, if you recollect. Now, for the reasons that Salil mentioned, the company is exploring opportunities for potential buyers and evaluating them. Now, once such a decision is taken to evaluate sale, we have to classify them as assets held for sale in our financial statements. That's the requirement of accounting standards. So we have done that. And after reclassification, we have assessed the fair value and taken an impairment. In the consolidated books of Infosys Limited Group, it is $18 million. But the write-down of value in the standalone books of Infosys Limited is $90 million.
Hi, gentlemen. Congratulations for a good set of numbers. Kritika Saxena from CNBC. Let me take the first question to Ranga, since he was just talking about Scava and Panaya. Will there be a further impairment given that you are looking at March 2019? Why such a long period for the sale? Are there any potential buyers that you have already identified? And I don't want to go into what has happened in the past, of course, but the fact is that a lot has been talked around Scava and Panaya. You bet big on Scava and Panaya. So what changed then? Are you admitting that it was perhaps a mistake to acquire these companies? What changed then? Salil, I want to understand the acquisition strategy from you as well now. There's a $75 million acquisition that has come in. It's largely around digital, creative, and consumer insights. So specifically in terms of acquisition, what are the areas going to be? Based on your strategic review, is it largely going to be these niche digital-focused companies? Could there be traditional firms as well that you would want to, firms with traditional capabilities that you would want to bring in? So that's for Salil. Salil, I also wanted to understand from you, based on your guidance, it does look like FY19 is going to be a better year, but if you can just give us a breakup. The fact is that, US was expected to be slightly soft last quarter. You were bullish on BFS, so I want to understand by when are you going to see that volatility in BFS reduce? In 2 quarters' time, do you expect that to start seeing a significant jump up? Will India continue to remain volatile for you in the near term? Praveen, a little understanding as far as the impact of the compensation is concerned, 80% already going to be given out. So remaining 85%. So remaining, by when would that come in? In terms of attrition as well, is there, given the fact that Q4 is slightly weakish on attrition, I want to understand from you what's your outlook in terms of bringing that down further. And Ranga, also if you can give us a breakup on margins. And you, I know there's a lot of questions to remember. I'll reiterate if you need.
Thank you. Let me take one by one. Coming to the Panaya and Scava, as I was explaining earlier, based on the management's intention to pursue sale, we had to reclassify them as assets held for sale, and we had to apply specific requirements of the accounting standards to assess the fair value. And we have taken a diminution in value and write-down of value of 90 million in the standalone books and 18 million. So aggregate at the group level, the impairment impact is 18 million. So the reason for March 2019 is not that we're going to wait, or it's a requirement of the accounting standards that within 1 year, we need to really see what opportunities are there to pursue the sale. Something like that. So I think that's where it is, and it's based on the fair value assessment. Margin, I think overall, as I was responding earlier, last year we gave 23 to 25% margin guidance, and we had a very robust operating margin performance. We ended at 24.3. This year, we looked at all the investments that we need to make in under-invested areas of digital, as I said, to revitalize our sales for much more accelerated deal wins. 3, to foolproof our US talent model, which we started last year. We want to further accelerate that. And 4th, of course, repurposing the employees, retraining the employees. So while we have given this guidance, at the same time, our focus on operational efficiencies, productivity that we have carried out, for example, all the indicators that I keep talking about, that unwavering focus will continue. So that's where we are.
On the acquisitions, I think first, so our view is we are committed to continuing with the approach on acquisitions which fit in with our future focus on strategy. Again, along the 4 elements, agile, digital, energize the core, reskill, and localization. The acquisition we announced today squarely fits into the digital scale-up for us. So it's really underwriting the strategy that we are more fully exposing in the market and executing upon. In terms of where we go in the future, we will continue to look for those. There's no time frame by which we'll do X or Y, but we are continuing to look at what will fit in to this digital framework that we've developed.
The second question was on FY19. US, India, the soft areas, BFS, by when do they complete?
Right. On the way we see the guidance for fiscal 19, my view is, given all of the dynamics in the market and our own internal businesses, that's the reason we set the guidance at 6 to 8. Financial services, I shared with you the numbers in a fact sheet. We have more granular numbers for financial services as well, and we see that being the case for fiscal 19. On India, we had negative growth in fiscal 18. We have large projects which were coming off. We see that the business in India, outside of those large projects, is in a good shape. Those businesses will continue, but as the large projects wind down, that effect will stay in the business.
So after 2 quarters, these soft areas will temper?
We've not given anything more specific than the 6 to 8% for the full year at this stage.
On the compensation front, as I said, for 85% of the employees, both on-site and offshore, compensation will be effective April 1st. First, a reminder, 15%, it will be effective July 1st. So that's the thing on the compensation. And from attrition front, while the attrition is marginally increased as compared to Q3, the high performance attrition has dramatically come down from 14% to 9.4%. So our focus is primarily focusing, differentiating people and making sure we continue to invest in people in terms of reskilling. That's very critical for us, and provide an environment where people are engaged and happy and motivated to work. So that effort will still continue, and we are not too worried about the 16% thing. It's in the normal band that we typically see. Yeah, it's seasonal for Q4. Even in Q1 also, you will probably see a marginal upside because there are people going in for higher studies and so on. But attrition will normally be in this band of 12 to 14, 16%. So we are not unduly worried on that count.
Thank you. Hi everyone, this is Rahul.
Well, that is Infosys, the first full quarter under the new CEO, Salil Parekh, and they've delivered in the March quarter. In terms of revenues, you could say slightly softer than what the street was anticipating, but bear in mind the March is a seasonally weak quarter. So dollar revenue growth of 1.8%, a constant currency growth of 0.6%, slightly lower than expectation, but that seems to have been offset by an improvement in margins to 24.7%. On their FY19 guidance, the company has come out with a 6 to 8% constant currency growth in line with expectations, implying that growth in FY19 will be better than FY18, and they will be investing heavily in digital, which is why their margin guidance has come down to 22 to 24%. But there is a little bit for the shareholders as well. So apart from giving you dividend, which continues at 70% of the free cash flow, they will be paying out an additional $2 billion to the shareholders via special dividend and some other way through the course of FY19. So that bonanza to the shareholders continue. And they're also looking to clean up the books. So Skava Panaya will be out and they're looking for a sale by March of FY19. Let's get in our experts. Dipesh Mehta, the research analyst at SBI Cap Securities, is here with us. Apurva Prasad is of HDFC Securities and Sanjeev Bhasin of IIFL. Apurva, your word, you've heard all the details.
Yeah, I think I would say it's net positive. So whether you look at the capital allocation change, the one time, I think that's a positive. If you look at the TCV of deal wins, I think that also is a very clear positive. And digital scaling, I think, is another example of how things are pretty much looking on track. So I think I'm quite happy with the set of numbers versus estimates. So I was, as it is, working with my numbers were slightly lower than street estimates. So I was expecting 1.7%. So not too much of a disappointment. I think the slight lowering of margin guidance will not really be having a negative impact as such. I think it's pretty much baked in the fact that there would be more on-site investments and a greater share of digital going ahead. So I would call it a net positive for sure.
Okay. Dipesh, would you concur that net, this is a positive set of numbers and guidance from the new management? And considering the stock has already run up so much, do you expect more upside from these levels?
Yeah, so broadly, I think I also concur with the view. Result is also broadly in line, tad lower in terms of constant currency, but I think considering the seasonality in Q4, not much to read, and FY19 guidance is also broadly in line with what we expected.
Okay, so what about, from here on, do you expect the stock to do better, Dipesh?
Yeah, we do expect. If you compare in terms of valuation, it is still trading discount to TCS. I think consistency in performance, we expect that gap to narrow down.
Okay, you expect the valuation gap of Infosys to TCS to narrow down. Sanjeev, again, same question. Everyone's asking that it's already put in a 12-13% rally. So what happens from here on to the stock?
Not 12% from its lows of 900 when there was despair, it's up 30%. And I see no reason for another 10 to 15% upside, given that the BFSI space, which generally in this quarter has been weak, in this year also. But look at the growth. On the Europe business, they are up 22%. The energy and utilities is up 16%. And I think a part of the margin decline would be attributed to, more hiring in the US, which will definitely, and some of the capex. So on a market cap of 250,000, I think a 10%, 15% upside from the positive guidance seems in case. And if the BFSI space actually picks up on the US side, because the other thing to look out for will be the impact of tax cuts, which will see increased spending on, on IT technology as a budget. The budgets will be higher. So I see no reason that this stock can scale 1300 by the end of the year.
Okay, gentlemen, thank you very much for your time. This evening, we've run out of time in this special edition of Infosys and the earnings gone by. We need to take a break. We'll come back with more news and analysis.